You're not late, you were placed late. Before you earned your first dollar, before you chose a career, before you even understood what money is, the order was already decided. Who gets access first? Who pays more later? Who compounds and who struggles to catch up? And the uncomfortable part is that it isn't random. It feels random when you look at individual lives, but zoom out and a pattern appears, consistent, repeatable, and built into the system itself. Right now, money feels simple. Work, earn, save, invest. That's the formula we're told. And on paper, it makes sense. But if that formula were complete, outcomes wouldn't diverge this dramatically. You wouldn't see entire groups accelerating while others stagnate, even when they follow the same advice. Same economy, same currencies, same markets, yet completely different trajectories. That gap isn't explained by effort alone. It's explained by position. And position in the financial system determines timing. Timing determines price. And price determines who wins. To understand this, you have to start where money actually begins, not in your paycheck, not in your bank account, but at the point of creation. New money doesn't appear evenly across society. It enters through specific channels: central banks, commercial banks, large financial institutions, government spending pipelines, and major corporations. These entities sit closest to the source. When new money is created, whether through loans, stimulus, or policy decisions, it flows to them first. And that early access creates a subtle but powerful advantage. Because when money is new, prices haven't adjusted yet. Assets haven't reacted yet. The system hasn't absorbed the change. So the first receivers are operating in a world where purchasing power is still high. They can borrow cheaply, deploy capital quickly, and acquire assets before the ripple effects spread. They're not guessing the future. They're simply earlier in the timeline. Think of it like fresh water entering a river. If you're upstream, you drink first. Clean, abundant, undisturbed. If you're downstream, you still get water, but it arrives later after it's been used, filtered, and sometimes diluted. The river is the same. The difference is position along the flow, now here, where the system becomes less visible and more powerful. When new money enters the economy, it doesn't raise all prices instantly. That's not how it works. The effect is gradual. At first, prices remain relatively stable. Then certain assets begin to move: stocks, real estate, financial instruments. These are the first to absorb the new money because they are closest to where it enters. So early participants buy into these markets before prices fully adjust. Then the second phase begins. As money circulates, businesses expand, wages adjust slowly, and demand increases. That's when broader prices begin to rise: housing, goods, services, everyday expenses. By the time this stage arrives, the majority of people are just starting to feel the effects of increased money in the system. But they're entering at a different point, when prices are already higher, so you get a sequence. Money is created. Early access uses it to buy assets. Asset prices rise. Later access arrives through wages and general circulation. And by then, everything costs more. The system didn't exclude anyone. It just didn't include everyone at the same time. And that difference in timing compounds over years. Because once assets rise, they don't reset. They become the new baseline. A house that was affordable 10 years ago is now permanently out of reach for many. A stock that once looked risky becomes standard in institutional portfolios. The entry point moves forward, but not everyone moves with it. Now layer in credit, because this is where the system stops being passive and starts reinforcing itself. If you already own assets, you gain access to cheaper credit. Banks see you as lower risk. You can borrow at lower interest rates over longer periods with better terms. And what do you do with that credit? Often, you buy more assets. Assets that are already rising in price. As those assets increase in value, your net worth grows. That increased net worth becomes collateral. That collateral unlocks even more credit. And the cycle continues. It's not dramatic. It doesn't feel like a sudden leap. It feels stable, almost slow. But over time, it compounds into significant advantage. On the other side, if you don't own assets, your relationship with credit looks very different. You can still borrow, but the terms change. Higher interest rates, shorter repayment windows, stricter conditions. And instead of using debt to acquire appreciating assets, you often use it to manage expenses: housing, education, emergencies, consumption. The same mechanism that accelerates wealth for one group becomes a cost for another. And here's the quiet irony. Both groups believe they're using money correctly. Both are working, borrowing, and participating in the same system. but they're interacting with it from completely different positions. One is upstream, compounding advantage. The other is downstream, absorbing cost. This is why the idea that anyone can build wealth with discipline is only partially true. Discipline matters, but discipline applied at different entry points produces different outcomes. Saving money when assets are cheap is not the same as saving when assets are already expensive. Investing early in a rising system is not the same as investing after the growth has already occurred. And the system doesn't reset to make it fair. It builds on itself. Every cycle, every expansion of money, every period of growth tends to amplify existing positions. Those with early access deploy capital sooner. Those without it react later. Over time, that gap widens. Now zoom out even further beyond individuals to countries. The same dynamic exists at a global level. Some countries sit closer to the source of global finance. Their currencies are stronger, their financial systems more connected, their borrowing costs lower. When global liquidity expands, they receive it first. They invest globally, acquire assets, and shape markets. Other countries experience the effects later. They face higher borrowing costs, more volatility, and less control over capital flows. They're participating in the same global economy, but again, from a different position in the sequence, so the pattern repeats. Whether it's individuals or nations, the structure is consistent. Proximity to money creation determines timing. Timing determines opportunity. Opportunity determines outcome. And yet, most of this remains invisible in everyday conversation. We talk about budgets, savings, and financial habits. Important topics, but they operate on the surface. Beneath that surface is a system that quietly distributes advantage based on access and timing, not just behavior. This doesn't mean the system is malicious. It's not designed like a conspiracy. It's designed for efficiency. Capital flows to where it can be deployed quickly. Institutions manage risk and markets respond to incentives. But efficiency doesn't guarantee equality. In fact, it often produces the opposite, because the system rewards those who are already positioned to act early. And once that position is established, it becomes easier to maintain than to replicate. So when people ask, why do some get rich faster? The answer isn't just that they worked harder or made better choices. It's that they were closer to the flow. They had earlier access, cheaper capital, and more leverage over time. They weren't just playing better, they were playing earlier. And if that's true, it leads to a more uncomfortable question. If wealth is influenced so heavily by when you enter the system, not just how you behave within it, then what does fairness actually mean in a system like this? Because the rules are visible, but the timing isn't. And in the end, timing might be the only rule that really matters.